Well, good afternoon. Happy Friday. Halfway through November. Let's get right to it. Not the greatest week for mortgage rates. Matter of fact, all the damage really done on Tuesday, which was the first business day of the holiday shortened week. And then we got Consumer Price Index, most widely recognized measure of inflation, on Wednesday. And the CPI was anticipated to tick up a little bit from last month, going from 2.4 to 2.6. That's exactly what it did. The Fed's target is really the personal consumption expenditures metric, not the CPI, but a lot of focus gets placed on CPI. Let's talk about this for a quick second. So I'm going to show you really briefly mortgage-backed securities. We can see this was Tuesday when we came back to work. Mortgage-backed securities sold off. There really wasn't a big economic report that came out here. Nothing riveting. This is just repositioning of the market. And you can see we've been relatively flat ever since. But let's talk about that Consumer Price Index, this measure of inflation. And this is the entire basket of goods here, or at least a summary of it. Here's the headline number, 2.6. And you can see all the different factors that go into this. And as we come down here to shelter, we can see shelter is still going up at 4.9% year over year, meaning that rents, as measured by the Consumer Price Index, are still going up at almost 5% per year. That is really not consistent with a lot of the data-driven markers that we have. Let's talk about this with CPI for a quick second. The way that CPI measures shelter is two measures of rent, and they're both surveys that are conducted by the Bureau of Labor Statistics, and the results of those surveys derive our shelter figure. The most bizarre one is called the owner's equivalent of rent, where you ask them, a respondee, how much they think their home would rent for unfurnished and without utilities, and that answer goes into owner's equivalent of rent. What's interesting about this table and what you can't see here is that all of these items are not weighted equally. This number right here represents about 42% of the overall inflation number. It is the single largest piece of the pie going into determining what our consumer price index is. And that survey question I just told you, owner's equivalent of rent, that survey question alone makes up about 33 or 34% of the overall inflation number. So when you're asking a question that's as open to interpretation as how much do you think your home would rent for unfurnished and without utilities, you're getting 1/3 of the total basket of goods there for the Consumer Price Index. One of the reasons why I think traders largely discount that number, if we go compare it to more data-driven metrics like, let's call the Zillow rent index, for instance, is a much more data-driven metric. You can see the Zillow rent index, this red line, has peaked in 2022 and has since been coming down. As a matter of fact, it sits more along the lines of about 3.27%. But if you look at the CPI measures of rent inflation, they peaked in early 2023. They're lagging indicators and they're still elevated at around 4.9%. And what does that tell you? That just simply tells you that the way that we're measuring shelter inflation is like looking at the last car and the roller coaster, the very last caboose at the end of the train. It's getting there last. It's not really very current data the way that we measure it with the Bureau of Labor Statistics, and I think traders largely discounted that. Let's shift to the biggest question that we're getting right now, which is, hey, rates have ticked up since the Fed started cutting on September the 18th. When are interest rates going to go back down again? And this is the time of year where all the forecasts start coming out. I'll show a couple of them to you. So here we are. This is a mortgage rate forecast from Fannie Mae, the Mortgage Bankers Association, Wells Fargo. And you can see as we move through 2025, everybody thinks we're going to be down sub 6%. Even the NAR says we're going to probably be near 6%, maybe a little bit lower than 6% as we close out 2025. And one of the interesting things there, and I would have begged to ask this question, is why? Why do we think interest rates will be going down? What's the data? What's the model that says interest rates will be declining? I heard someone speak recently that said they think the spreads between the 10-year Treasury and the 30-year fixed are going to stabilize or normalize or come closer together. And my question back to them would be, why? Why would that happen? And listen, this isn't me being doomsdayish. I want interest rates to come down lower. I want to believe that they will, but I want to believe it because of data, because of something concrete, not because it's what I hope for. Because if we don't really focus on what's true, then we can't go about fixing it. And so what are some reasons why mortgage rates would improve? Well, they would improve because there's more investment in mortgage-backed securities. That's certainly not going to come from our Fed. They're not going to reinstitute quantitative easing. And as long as inflation remains a little bit of a concern, I doubt we're going to see a lot of investment there because mortgages are bonds and bonds hate inflation. And so I don't think we're going to see a tremendous amount of investment in mortgage-backed securities. That leads us to maybe weaker economic news, specifically around labor. Listen, if we can see jobless claims creep up maybe over 300,000 per month on a 4-week moving average, maybe unemployment starts to get up into the high 4s, low 5s. Yeah, now I can see that we would see a little contraction in the economy and interest rates in general would come down. That's certainly a plausible possibility, although we're really not seeing that data in jobless rates. Let's take a quick look at jobless rates. We'll come down here. We got that reported this week, and you can see right here, initial claims came in under expectations at 217,000. We really haven't been beating jobless claims to the high side, and unemployment remains in the low 4s. I just don't know that I see a weaker labor market on the immediate horizon. Perhaps it's coming in 2025, which takes us to the last thing that could improve mortgage rates and would do it immediately. And that's legislative changes around the Federal Housing Finance Agency. For instance, if we rolled back some of the heavy-handed loan level price adjustments, if we normalized some of the G fees that are charged to lenders, pricing would immediately improve overnight, and that could get passed through to the consumer. That would help improve affordability and take existing home sales from 1995 levels back to something from this millennium. So hopefully we'll see some of that, although that's tough to hope for because there's no real chatter about it right now. In the meantime, we'll keep our eye on the ball and hope for better news on the interest rate environment as we move through the balance of the year. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Thanks.